Good morning and welcome to your exam review for exam 2. We are not going all the way through chapter 7, just as far as we got. And that digital property one that we did in class. 10 questions will be multiple choice, 10 short answer, where I can try to give you points, and 2 calculations, that infrequently traded stock one that we did on the board over there, and the dual basis that we did on the board over here. And I am going to skip ahead to the newer stuff and then come back to the older stuff. Let's go with okay, we can start with property types of. All right, so digital property goes in with intangible, but we've got different ways of dealing with that. Real property is our land, the house that's affixed to the land. A mobile home may or may not be real property, depending on what potential paperwork they filed, how they fastened it to the land. Tangible, things we can easily move. I'd say pick up, but I can't pick up a car, not yet. Key ownership features of these different types of properties. Sole ownership is the most common. I own my shirt, it's mine, I can do whatever I want with it. I can give it away, I can sell it, I can rip it up, I can do this while I'm alive. When I pass away, I get to say where it goes, as long as I made the will. If I've died intestate, then the government's gonna say where it goes. I don't need anybody's permission to do things with my shirt. Step to fair market value basis. If this is a really valuable shirt that becomes extra valuable, whoever inherits it at the fair market value when I passed away. So we step to that basis, whether it's stepping down because it's now a used shirt, or stepping up because it's somehow appreciated in value. Tenants in common, 2 or more people. We don't have to be related. We can own different percentages of ownership, and my piece, my 10%, my 25%, whatever it is, I get to do whatever I want with no input from the other owners. I can sell mine, I can do whatever. My percentage of whatever I own is part of I have to pass it somehow. So it's gonna be part of both my gross estate and my probate estate, because I have to retitle it in some way. So sole ownership and tenants in common must be retitled, they gotta go through probate. Joint tenants survive survivorship, tenancy by entirety, and community property. The way they're titled, we know where they're going. Tenancy by the entirety, only for married couples. Same with community property, they're just a married couple living in the community property state. So we know where it's going based on how it's titled. It's going to spouse. Joint tenants with right of survivorship potentially have unequal ownership amounts. That's going to vary by state. Some will require specific. We always have this deemed 50% contribution rule with spouse, with joint tenants with rights of survivorship and tenancy by the entirety, and community property. Do you remember how we can have separate property in a community property state? Yes.
If it was acquired before the marriage.
Okay, so property that I owned before marriage, tricky part on that comes with, well, now it happens. So I had a defined contribution account with my employer. I was working there 5 years, then I got married, worked another 10 years. So now the previous 5 years, can I separate that out as mine? And then the next 10 years that I worked there, what amounts are co? Other ways I can have my own property in a community property state, and assuming I'm married. What's something that I could receive during the marriage? Yes. Somebody died, yeah. So I inherit my uncle's asset, whatever it is, and it's directly to me in my name. Or uncle gifts me something. So something came directly to me in my name, and I continue to keep it separate. Once I commingle it, it's gonna be really hard to trace, well, that dollar came from uncle, and this dollar was from my work, from spouse, from whatever that went into this account. Once you've commingled, it's really hard to separate that out, especially as time passes. Oh, that step to fair market value. Remember with my joint tenancy with right of survivorship and tenancy by the entirety, I have my original 50%, saying I'm a spouse. I've got my deemed 50% ownership from the basis when we purchased it. It increases in value, spouse passes away, I get to step to their half of that, but I still have my 50% of original basis. So we bought something for 100,000, 50,000 each. I keep my 50,000. The property itself increases in value to 200,000. Their half, my spouse's half, is worth half of 200,000, 100,000. I get that full 100,000 for their half, plus my original 50,000. So my basis is now 150,000. If it's community property state, all of it jumps up. So I just take the fair market value on date of death. Let's go back to one point on that. We've got that deemed contribution rule for spouses. And this joint tenancy with right of survivorship, if spouse and in the correct state, we can, with that actual contribution rule, it doesn't have to be dollars for our friends that we're owning something with. They could put in sweat equity or something else, and we can just decide that that's worth 20% or whatever percent of the basis. But we need to decide that early on, and we need to put it in writing. We need to make it very clear. Other ownership topics, life estate. I get to enjoy this asset, whatever it is, for the rest of my life, or for a term. We saw that with the qualified personal residence trust, where I get to live in it for 10 years, and then it belongs to daughter. And daughter can kick me out in the street if I am still alive. Although if I pass away during that term, I put my own house into the qualified personal residence trust for a 10-year term for myself. If I die during that term, that is going to be included in my estate. Usufruct, same thing as a life estate, just in Louisiana because they follow the Napoleonic Code instead of English common law. Some mixes. Legal versus equitable ownership. We saw this idea in financial counseling with a mortgage, where the bank has the title to the house, but you're living in it, you're painting the walls, you're renovating the bathroom, you're doing whatever it is that you want to do to that home. You have the beneficial, equitable title in that. We'll see this in trusts in estate plan, where the trust owns the actual asset, the castle, the stock, the whatever, and then the beneficiaries of the trust get to actually live in that castle or receive whatever payments are coming out of it. Yes?
So if you, like an asset, and you just title via like a life estate, does that count towards your estate when you pass, or does it count towards the person that like actually?
So it's gonna count towards my gross estate, but it won't have to be retitled.
What does that mean? Like, what do you mean?
So it's not part of my probate estate.
Oh, okay.
So I have a life estate, it's
Yeah.
mine now, and because I died with that, that value is part of my gross estate, but I don't get to give it to anybody.
Yeah, he
Just like my general power of attorney with Elon Musk's everything. Part of my gross estate is all his stuff, so I'm definitely taxable, but I'm not able to give away his stuff because I don't have it anymore. My power died with me, but because I died holding that power. Same thing for the life estate. I died with this benefit. And for the term, if I died during the term, it's included in my gross estate. If I passed that term, so 10 years of, put a 10-year qualified personal residence trust, it's year 11, I'm renting it for my daughter, that's out of my estate. But if I had died in year 9, it would be part of my gross estate, not my probate. So point of probate is to retitle assets that are not otherwise retitled some way. That revocable trust becomes irrevocable when I pass away. All that sole ownership, the things that my shirt, the things that I own by myself, they need to be retitled somehow. Same thing with Tennessee and Common. It's public, so we wanna put as little as possible going through this probate process. Not only is it public, it's going to cost more money, and it's going to cost time. It'll be a while before our loved ones are able to get these assets that need to be retitled. It's public because all the creditors out there, Visa's gonna have somebody who their job is to find out who died today. And did those people that died die with a balance on a credit card from Visa? So they're going to have their chance, Visa, banks, whoever you might owe money to, they get a chance to say, hey, Rich owed me money and the estate needs to pay me. So the executor has to figure out all that, figure out all the assets. I'm gonna put these creditors on notice with my public, hey, Joey died, speak now or forever hold your peace creditors. Creditors make their claims, executor pays them out, pays taxes, and then the loved ones get the dollars. Yeah,
I thought your debts like died with you.
student loan does.
Credit card debt doesn't?
Nope. Credit card has a claim on the estate, but if I die broke, then it would die with me. So my loved ones aren't responsible for my credit card debt.
Okay.
So if I die with an overdraft on my bank account, zero retirement account, zero anything of value besides my clothes and whatever the cost of my, or whatever dollars my used clothes and stuff in my refrigerator bring in, that's not enough to pay off the tens of thousands of dollars of credit card debt that I've got. Those creditors are just out of luck. So in that case, it would die with me.
Yeah.
But if there are dollars in the estate, the creditors get first claim. The creditors, the taxes, they get paid before loved ones get paid. And loved ones might not get paid because creditors are owed so much. Not all debt might be paid if there's not enough to pay them.
Yeah.
So in that sense, yes, it does die with you. If somebody is co-signed on a loan, that debt lives on, they're still responsible for it. Now, I'm talking about the time cost. The more complex an estate is, if somebody is suing the estate, if there are assets in other countries, other states, all these things are going to add to the complexity of the estate, which is going to add to the time. Cost of that, we gotta pay the attorneys, we gotta pay all these filing fees, more complex, more costs. And it's public, so we want to not put the trust terms like we saw Disney doing, like we saw some of the other trusts that we looked, or some of the celebrity wills that we looked at where people were providing information that they did not need to provide the general public. They could have just said, I leave this to trust A. And all the terms of trust A are in trust A, but not in this public document that anybody could read. If I have any type of account that I can put a beneficiary designation on, I don't need to even mention that in the will. And if I were to mention it in the will, it doesn't matter if I say in my will I want this to go to Joey. If the beneficiary designation says it goes to Susie, it's going to Susie. It doesn't matter when I made the will or that beneficiary designation is always gonna win. It's going by contract, so we don't need to mention those things. So, executor or that court-appointed administrator, if I fail to name an executor in my will, or the executor, contingent to the contingent executor, if none of them are alive, they're unwilling or unable to serve in some way, court-appointed administrator. So the job of either executor, court-appointed administrator is the same. They are going to marshal all the assets, basically figure out net worth. Here's all the assets of the decedent, here's all the liabilities. And the decedent, I say of the decedent owns nothing now. The decedent is dead, the estate owns all this. The executor is gonna find all that stuff, figure out what debts are owed, and make sure that the stuff stays safe while this probate process is happening. So I'm gonna make sure things are secured, things are locked away that need to be locked away, things are insured that need to be insured. And I'm acting as a reasonable person. I don't have to be a CFP, I don't have to be an expert in investments or know all these rules. I just gotta act as a reasonable person with my background would act. I will do my best to honor the decedent's wishes, to pass things as they wanted. If something no longer exists, that's just gone. I don't get to substitute something else. Example I gave was I left my Camaro to my daughter, but when I died, I didn't have a Camaro, I had a Mustang. Those are two different things. So now daughter doesn't get a car at all. If there is a dollar amount that I put in, and easy to get around this by just putting percentages, but I say I wanna give $500,000 to Susie and $200,000 to Billy. Well, if those dollars don't exist, the executor's gonna do their best to, well, what's the equivalent of that? I can't quite give them 500 and 200, but I could give them 257, or however that math works out.
So redemption would be like the example of, like Camaro, Mustang, you did,
Yeah.
abatement would just be like you don't have, like, enough to like,
Yeah,
but they
So-
would still get the residuary.
they would get as best I can, so let's say 100,000 to Susie, 100,000 to Billy, that's 50% each, equal amounts. There's only $10,000 in the estate, they each get 5,000. So the executor's gonna do their best to honor the decedent's wishes, even if there's not enough to give it. But if the asset itself doesn't exist, I can't give away something in substitution. What the decedent could have done is either update the will or that codicil. So the codicil, a legal document where I just change one small thing. I say, everything else in the will is great, I wanna change this Camaro to Susie to the Mustang to Susie. And now if somebody were to contest the will, to challenge the estate, they gotta go through that codicil. I've got a shield of armor up in front of my will. It's a higher legal standard for me to create a codicil than it is for a will. So they've gotta prove that somehow I was under duress or didn't realize what I was doing, incompetent, something that makes this not valid. And then they gotta attack the will. So a separate thing. I can make as many codicils as I want, changing one small thing. And they gotta challenge them one by one. So instead of going through that public probate process, the biggest thing that financial planners can do for clients is make sure that their beneficiary designations are up to date and correct. That will take a lot of people's estates right there, just their retirement accounts, their investment accounts, going where they want it to go. You can make the beneficiary an individual, a trust, a charity, whoever you want, and you can get complex with those beneficiary designations, saying, I want 50% to Billy, 25% to Susie, 18% to somebody else, and we can have contingent beneficiaries for each. We can put that per stirpes, per capita language in there if we want to go to lower generations, younger generations, I should say. State titling, we saw that tenancy by the entirety, joint tenancy, the right of survivorship, and community property that passed because of how they are titled. Others, we have to go through probate. So tenancy in common and sole ownership. State trust law, we had our revocable and irrevocable trusts. I could create a revocable trust while I'm alive. It becomes irrevocable when I pass away, because I'm not around to change it. Digital assets, all those files, everything you've got on your computers, where does that go? Do you want your sister to have your estate planning notes? Maybe. But what is your plan for all these different assets? If you have some sort of revenue coming in, you're an influencer, you have social media accounts, you have emails, you have all these different things that something needs to happen to. So what is your plan for those? Who is going to take over some specific social media? Maybe you want it to be your friend or your sister, or maybe you want your parents to have your email account, or whatever else it is. Maybe it just dies with you if you don't have anything set up and nobody has a password to get in. All right, gifting. We have the donor, the donee. Donor is the person that's giving the gift. They have to be competent to give the gift. I can't take a watch off of somebody that's asleep. They have to actually give me the watch and want me to have the watch. I'm not robbing them. So they were competent and they were doing this voluntarily. They intended to give it to me. Donee, also competent. I can't throw a watch at that sleeping baby or awake baby. They have to take delivery, receive it. They've got it right now. They have to accept it. So I can refuse that swampland in Florida because I don't want it. But once I've accepted it, the gift is complete. We have our exception to that with that mailbox rule. We count it as if you have received and accepted it. It's a completed gift. You may later decide to throw that gift card away or whatever it is, but as far as the donor is concerned, that's a completed gift. You received it.
If you do like a mailbox net gift, does like, does the recipient have to like do something to receive it there, or like can you still like give them something and then they'd be liable for the taxes?
That's a great question. So net gift, you're giving it to somebody and they're responsible for the potential taxable gift. They would have to file the paperwork with the IRS saying, I received this gift, this is what the taxable amount is. If that tax is greater than my basis, then now I've received a benefit. So if I'm the person that gave it to you as a net gift, and the taxes you pay is greater than my basis, I have received a gift. I don't know if we can get around that with the
Yeah.
mailbox rule.
No, it's okay.
That's a good question.
I didn't know if it was like a short, like a, you know what I mean? Like that was-
Maybe, yeah. I'll look into that. It won't be on the exam. but I'll look
Yeah,
into
no, I
that.
figured it would be, I was just kinda curious.
Without full consideration is that key of, I could have a partial gift, partial sale. So I give you the $10,000 car, but I charge you $2,000 for it. So partial gift, $8,000, partial sale, $7,000. With full consideration, that's just a sale. I just sold you a car for a fair price. And we can have that arm's length transaction with strangers or with loved ones. So consideration, I received something. I could trade the boat for the car. We could trade dollars for whatever the asset is. We are getting something. Consideration is that something of value that I give you when I buy it from you. And for the fair consideration, if I'm selling to a stranger, IRS assumes that we are both trying to get the best price for our perspective, from our perspective. If I'm selling it to you, I'm trying to get as much money as possible. If you're buying it from me, you're trying to buy it as cheaply as possible. So they just assumed that was fair. And even if it turns out that dresser that I sold you for $20 at the garage sale is actually worth $200 because it's some kind of antique dresser, I just didn't know better. I wasn't trying to make a gift to you of that antique dresser. Annual exclusion. In order to use it, we have to have that present interest. It's yours now, it's in your hot little hands, you can play with it, you can do whatever you want with it. That's present interest. If we have present interest, I can use my annual exclusion. Up to $19,000 I can give to everybody, and this is throughout the year. So if I give somebody a present this month, and then in October, and then in December, all three of those presents combined are what I gave to that one individual. So it's that $19,000 annual exclusion per individual. I could give 1 billion people $10,000 and I'm not paying any gift taxes because each gift was individual. If it's to your spouse, we've got unlimited. If it's to your non-US citizen spouse, $194,000 a year. The idea being that if we're married, we're a single economic entity, but alien spouse might go back to whatever that country is and not pay taxes in the United States. So the US government says, well, no, we gotta put some restrictions on that so that we make sure that the dollars stay here and the taxes get paid here. If I'm married, I can split gifts with spouse, and if I do so, that's for all gifts for the entire year, unless we get divorced or one of us dies, and then gifts after that date would no longer be split. Splitting gifts doubles up that $19,000, so my $19,000 and spouse's $19,000 combined for all the gifts that either one of us make. Single economic unit, spouse makes a gift, we made a gift. When I gift you gift, we gift.
If there's partial consideration on a gift, like, let's say it's worth 20,000, someone pays 10,000, do you get to use like a $9,000 deduction or on that for like, for the portion that, or
So
how does that work?
I might file that 709 and just say, hey, I made a gift of $9,000, but it's below my annual
Or,
exclusion.
yeah, if it was more than, like, I guess that was a bad example, let's say it's like $100,000 and someone paid like 50,000 or whatever, so you're, like, would you file something saying for like the difference?
Yeah,
Okay.
and I'm still gonna apply my 19,000 to the 50,000
Mhm.
or 38,000 if I'm splitting gifts.
Yes, yeah.
So the rest, that's a taxable gift. I'm probably not paying taxes now because I still have my up to 15 million over my lifetime plus my estate combined.
Yeah, but you, okay. I was just.
But yes, I would file in that case and say, hey, I made a taxable gift. This is what I received, $50,000. This is what it was worth, $100,000. So I made a taxable gift of $50,000. It was present interest, so I'm gonna apply my annual exclusion, and this is my total. So like,
Mhm.
the form will let me put all that stuff in there.
Yeah, okay.
Talk about the present interest, future interest, they may never receive it. They can't immediately use it, enjoy it, whatever, right now. So that's like a gift to a trust. I can make that gift to a trust a gift of present interest by allowing that window of opportunity, the crummy provision that allows the beneficiary to take those dollars for 30 days, 60 days, whatever. Examples I've been giving are Merry Christmas. I made this contribution to the trust fund in your name, and you have 60 days to take out the contribution. So now I've created that present interest. If they don't exercise it, they let that power lapse. Awesome, the dollars stay in the trust, and I'm able to use my annual exclusion. But I'm also, that contribution that I put in will be with whatever strings I put on the trust. So I'm controlling how it ultimately goes to that person. Yeah.
If they let it lapse, it activates that like 5 and 5 rule, right?
If there are multiple beneficiaries to the
Yes.
trust.
Yeah.
So real world, just make 3 trusts. Or, however many kids we've got, instead of having 3 people with 1 trust and trying to do their crime vision that way. So when Alvin, I think it was the Chipmunks, right?
Mhm.
Alvin lets his power lapse, he made a gift to the other 2. They're all making gifts of future interest to the other 2 in the trust.
Less 5% of the trust or $5,000.
The lesser of, yeah, so we get to reduce it by that amount, but we
It's
still.
the lesser of or it's the greater of?
You're right, greater of.
Okay.
Yeah. So by letting it lapse, you make a gift to the other people. You can't make a gift to yourself.
Yeah.
Real world, just make 3 trusts.
Yeah.
They're the same term as the attorney isn't gonna charge you that much more to create another trust with just another name on it.
And we won't need to do like any of those calculations?
You do not have to do the crummy calculation, but know what the crummy is.
Yes, gotcha.
Yeah.
Okay.
The 2 calculations are dual basis with a gift and infrequently traded stock, evaluation of. So there's the crummy provision. Only if we have more than 1 beneficiary in that trust. Otherwise, we don't have to do the calculation. We can still use the crummy provision, creating that window. You want to do this math either. Think conceptually, if I make a loan to my daughter, less than $10,000, government doesn't care, they're not really looking at it. If it is between 10 and 100,000 or over 100,000, now they're looking at, okay, what is the applicable federal rate, which is pretty low. If I charge the applicable federal rate, cool, it doesn't matter. And that rate is going to be dictated by whatever month I made the loan. So we can look that up, it's gonna be like 3-4%, something like that. And that's what we're using to make this calculation to figure out if I made a gift or not. You won't have to do that calculation, recognize that the government sees these loans as a gift, but they don't care if it's small amounts. And if it's large amounts, we're still not too worried about it. It's not gonna be a large gift because our interest rate can't be that much lower than 3-4%. Not a gift, transfer to a political organization. A gift, transfer to a political candidate. So I can't give to a specific person's campaign, but I could give to the Republican Party, the Democratic Party, the whatever actual political organization. Qualified transfers, that's the direct payment to University of Alabama to pay somebody's tuition or any educational institution on behalf of somebody else, as long as I make it directly to the educational institution. Now I don't have to worry about that gift tax or anything else. If I'd given them those dollars and said, use this to pay your tuition, that's a gift. Other is medical. So whatever that healthcare institution was, as long as I pay your medical bill directly, not a gift. Payments for support, and I'm gonna combine that with payments to divorcing spouses. Court has ordered this. So I've got alimony, I've got child support, I've got the separation of that 401k, whatever assets we have, all of that is just our equitable-ish division of the estate. And then court ordered, I gotta take care of my kid, and potentially alimony as well. Transfers in a business setting, you get a gold watch in retirement, not a gift, it's part of your job there. You get a bonus for sales, not a gift, that was for you making those sales or whatever else. That's just looked at as employee-employer. We're trying to recruit, retain, and attract the best talent, just like retirement plans. Gifts to spouses, with our exception for the alien spouse, and then charitable gifts, as long as it's a 501c3 charity, unlimited to spouse, citizen spouse, and charity. Advantage of the charitable gift, I don't have to pay capital gains, and I get to take a deduction for the amount. So if I have a highly appreciated asset, or I have a client with different types of assets, one's highly appreciated and they want to give to a charity, I wanna give that highly appreciated asset, or at least some of it, whatever their tithing, gifting amount to that charity is. Whatever they wanna do, I wanna do it with the highly appreciated one, because that gives less money to the government, more money to the charity.
You could like give it, you would have the same effect giving it to your spouse though, right? 'Cause they're
Well, I guess I still don't have to pay capital gains, but eventually spouse will.
Yeah, so eventually the spouse would wanna give it to, charity, I guess, right? Is that?
If they wanna give to a charity. Maybe they're just like, no, I'm gonna go buy a yacht.
Yeah.
So the idea is only the charity allows me to take the deduction.
Yeah, okay.
Talking about the highly appreciated asset going to charity, things that I think will appreciate over time, if I get it out now, like as soon as I get rid of it, I put it in the trust, the irrevocable trust, I gave it to somebody, I donated it, I did whatever, it's no longer mine. So whatever happens to it after that is not on me, it's not in my gross estate. So if I see something that's gonna appreciate a lot, I wanna give it to somebody that is going to have more time for that appreciation to be appreciated. And we talked about this effective and efficient idea. Effective, it goes to the correct person, entity. Efficient, I have also done it in a way that gives the most dollars to my loved ones. And maybe they don't need to have it in trust because they're too young to manage the asset or the whatever. And that would be the gift to minor. We may need somebody to help them out with that. Greatest future appreciation, the younger person. Property with fair market value less than the basis, that creates that dual basis. If I keep it, I can sell it and I get a capital loss. I get to reduce the taxes that I pay. And then give the dollars from that sale to somebody if I want to. So I get extra benefit from that. If I give it to somebody, now they don't know what their basis is until they part ways with that asset. They gift it to somebody, And their basis is either going to be what they received it at, or that original basis. So IRS is trying to help them out. It's going to be whatever most beneficial to them. They're less likely to have to pay capital gains, and they get my holding period with that higher value. So it would also be long-term, more likely to be long-term capital gains, rather than if they have to get rid of it for the lower price, then, well, they could have capital loss there, but it's gonna be short-term capital loss. And if we're in between, there's no taxable event in between those two amounts. Appreciated property to the charity, because I don't pay the capital gains, and I get the deduction. Somebody that maybe needs a steady income, they're retired, maybe give that income producing property to them. Dividends, coupon payments, rents, whatever the asset might be.
If you sell at a loss, does it just reduce your capital gains, or does it reduce your estate also?
So if I'm alive, it's allowing me to take that capital loss. If I had passed away, that's just what the value of the asset is. It doesn't matter.
Like I'm saying, like if you sell it like when you're alive, it reduces your estate by that like assets value.
Yeah, the asset's gone.
Yeah, okay.
But then if I sold it, it was worth $20,000 when I bought it. It's worth $10,000 when I sell it to you. I still got to have $10,000. So I have to do something with that $10,000. So that specific asset, yes, is out of my estate, but the $10,000 is in my estate.
Yeah, there you go. Thank you.
Yep.
Sorry, that was a question.
Gross estate, we've got our A, B, C, D, E. Administrative costs, burial costs, so administrative funeral, casualty losses, C, D, debts, last medical expenses, E. I would put those two together and just make an A, B, C, D, but throw in an E if you want. That gives me my adjusted gross estate, and what's in the gross estate is everything that I own or had control over with that 3-year clawback. If I die holding a general power of appointment, all of that is part of it. If I die with my qualified personal residence trust during that term, that's part of my gross estate. So anything that I have power over or get to enjoy right now is part of it. As much as I want can go to charity and spouse. I can pick and choose what goes where. And don't forget about that portability feature. So I don't want to just say all to spouse. I want to also give spouse what remains of my unified credit. Could be 100%. We may never touch that unified credit because we gave everything to spouse. But I can also give them, and only them. So portability only works for spouse. I can give my unified credit to spouse. And now when they pass away, they have my unified credit stacked on top of whatever that is in the year that they pass away. Whatever gift tax I may have paid, probably gonna be 0 for most people. And then our big thing, this unified credit that allows me to have, like, all the way down here. By that point, I've got 15 million, cool, still no tax. Even after I gave to spouse and after all those things, if I still have $15 million, I'm not paying any tax. Valuation of assets. Almost always, we're going to have what is the value the day the person passed away. And people that receive that, or whatever portion of that, they step to that basis. Their basis is the fair market value on my date of death. If we do the alternate valuation, executor has to do that in writing, and it's gonna be rare that they're eligible to do so. It has to be a taxable estate. Most estates aren't gonna be taxable. And we have to think that it is artificially high right now. The valuation is artificially high because of whatever going on in the market, or whatever going on in the greater global economy. I own a whole bunch of oil and gas stuff, and it's artificially high right now. And I think if I wait 6 months, it will be lower. So those two things must be true. Anything I sell from date of death to the 6 months, that's the value of that asset. Depreciating, wasting assets, fair market value, date of death, they'd have naturally been worth less. Things that are kind of gonna be a subjective value, so like my 401k, we know down to the penny exactly what that is worth. For a home, for jewelry, for fine art, maybe we wanna get that appraised to say this is what it's actually worth. Different discounts that we talked about. Before that, closely held business or other things. Minority discount, we saw that with the family limited partnership where they really couldn't do something with their 50% ownership because I was the general partner with my 1%, but I made all the decisions for the business, got myself a salary, hired, fired, whatever things were going on in the business, I was running it. Even though you own 50% of it as a limited partner, that limited partner ownership doesn't give you any income or value, so it could be really hard for you to sell that. So also a lack of marketability there. Blockage,
I was just gonna say, for those like valuation discounts, there's not like a specific formula, it's kind of like gauged case by case, right?
Yeah, so each one would be individual and reasonable people could differ.
Mhm.
So we could come up with, I think this is a 70% discount or a 30% discount. Two people could independently reasonably come up with that. So you have to make the case for it, explain why you think it's worth this much, and submit that to the IRS. And then the IRS can say, no, it's actually worth more than that, or however they want to look at it.
Thank you.
So be sure you know how to do this math. This will be on the exam. The tricky part is trading price after, days before. Trading price before, days after. So we're just swapping those two and then dividing by the total number of days. That's really the only way I see people miss this. Actually, no, I'll take it the one other way. We want the average of the high and low of what it was traded at. So I'll probably give you opening price, closing price, high, low, and you have to figure out how to do that. So the average of the high and low is that trading price. Weekends don't count when you count your days. It's just days that the market would have sold. Not all stock trades Monday through Friday. So I think Google would trade Monday through Friday, not a big deal. Some stock, like it didn't trade on Thursday or it didn't trade on Wednesday, we're going to try to get to the most accurate price for that day it didn't trade to get to our fair market value.
Wait, are you saying like if you're calculating that, like a day between? Oh, okay, never mind. Sorry, I was thinking like if you're saying like if there's a day between. I'm gonna get way too confusing, but I understand it. So
Okay.
my bad. I'm not gonna waste your time.
It's never a waste. I'm always happy to
No, I
answer.
just misunderstood it at first, but I'm good now. Thank you.
Weekends and holidays, we don't count those days. We just glide right over them.
Yeah, thank you.
Arm's length transaction, this is the idea that it's to a stranger. A sale, easy, I give you my car, you give me some money. Installment sale, I go to a dealership and I pay every month for the next 5 years to buy that car. Exchange, I trade my boat for your car, maybe we're putting some dollars in as well. The way that we can make a tricky, for the benefit of someone, I'm trying to disguise this gift as an arm's length transaction. We have the self-canceling installment note and the private annuity. With both of those, I think that the IRS life table and my actual date of death are different. I think I'm gonna die sooner than the IRS life table thinks that somebody my age is gonna die. I've got poor health, whatever's going on. So to my loved one, I say, hey, you make me, it's the private annuity, you pay me this much for the rest of my life, we're gonna figure out this asset, the ranch is worth $1 million, you're gonna pay me $100,000 a year, let's say $105,000 a year for the next 10 years. I think I'm gonna live only 5 more years. They pay for 5 years, they get that asset for $550,000 instead of $1 million, that's gonna be their basis. Risk to them, medical advances come out, I live even longer than the 10 years that the IRS expected me to. They gotta keep making payments to me for the rest of my life. With my end, the risk is they stop paying me. I'm failing in health, I'm hospitalized. In order to get them to pay, I'll win, but I gotta go to court. We have a contract that says they gotta pay this to me and they've stopped paying, but I still have to go to court. With the self-counseling installment note, I can potentially take the ranch back if they miss a payment. So like the repo man that takes the car, I can take the ranch back. With the self-counseling installment note, we are giving them the basis of whatever we originally agreed that property was worth. If we said it was $1 million ranch, cool. Their basis is that $1 million, even if I died during the term of this note. So it was a 10-year self-counseling installment note. They paid a premium to make it cancel. It canceled when I died 5 years later. Their basis is the $1 million. We talked about our grits and grats. Grantor retained trust, A, annuity, I, income. With the grat, we calculate the value of the annuity when we create the trust. And it's gonna pay me an annuity for the next 10 years. Same amount every month, every year, whatever it is that we put it to do, even if it has to go into the corpus of the trust. With the grit, it's just the income. That can vary every payment based on whatever the valuation is, or whatever income is produced. I can choose, I can make it a very generous annuity to myself, or I can make it a small annuity to myself. So I get to choose how I set it up. Grat, we value that when it's created. The grut, we have to revalue every year. So the grantor retained unit trust. If I want to get even more into this, I create the intentionally defective grantor trust, where I retain the power to change the investments in the trust. This means that now I am responsible for the taxes on the trust, where with the grit and the grat and the grut, and this can be set up as a income annuity unit trust, but with those where I didn't keep that power, the trust itself is paying taxes. With the intentionally defective, now I'm responsible for taxes. So I'm taking these dollars out of my estate, and I'm taking more dollars out of my pocket, out of my estate, to pay taxes on the trust. So I do this intentionally.
What did you mean, like valuing the annuity in the grat? Like what is, like you do that at the beginning? What is that? Did you already kind of know what like your like? I'm kind of confused by that.
The value of the trust when I create it is how we determine the value of the annuity, and then also how much I want it to pay me.
Okay. Versus like checking like the other, what was the other one?
The grut?
No,
The
yeah,
grit?
Yeah, grut, yeah.
Okay, so the grut, I could put more dollars in later. The grat, I can't, it's locked.
Okay.
Because we created, on whatever, March 28th, this was what I put in, this was the value. We're doing this calculation because I want a hefty payment coming out of this, a hefty annuity every month to, at the end of 10 years, I imagine this much will be left. I don't know what's gonna happen to the assets in that 10 years.
Yeah.
But I should be able to get that steady stream of payments for that period of time.
Can you walk us through one like dual basis? I think I was confused on that. I know it's kind of obnoxious, like in 1 minute.
Yeah. And then that was your final slide. So the review will be up, dual basis. I'm gonna do on the board for you. Okay, so gift. I have too much stuff on the board right now. Okay, so we have a gift that goes to Susie. Let's say this is 10,000 and this is 5,000. I bought this gift however long ago. The person that receives it, so I bought it for 10,000, it's worth 5,000 now. So when I give it to you, it's worth $5,000. I could have sold it, taken the capital loss, that's what you want your clients to do, but we didn't do that. We gave it to them when it was worth $5,000. So now Susie doesn't know what her basis will be until she sells it or gifts it or does something to it. She sells it anywhere in between, no taxable consequences. She sells it for less than 5,000, she's got a capital loss. Short-term or long-term, we don't know until
Based on what?
based on
The
this
basis?
date. So she'll have capital loss down here, and her time period, her holding period starts the day I gave it to her. With the gain, her time period starts when I had it, so if it was a year ago or whatever. So she doesn't know her holding period or her basis until she sells it.
Yeah, but like if she sells at 5,000 and that's a loss, I guess, right?
5,000 would be nothing, it'd be $4,999.99.
Okay, so let's say she sells it like 4,000, so that's a loss of,
$1,000.
yeah.
So she gets a capital loss of $1,000, and her holding period will be dictated by when I gave the gift to her.
Okay, and if it appreciates more than, let's say, this goes to 15,000, so it's outside of that range, is that a gain of 10,000 or is that a gain of 5,000?
5,000. So her basis is 10,000 if it's a gain. Her basis is 5,000 if it's a loss. Anything in between, no taxable event.
Okay, that's what thank you.
All right, roll tide. I'll stick around to answer questions for a minute.
Yeah, that makes sense. Wow.
No, I haven't, I wasn't asking